Good afternoon, everyone, and welcome on board today's session. I'm Ranjana Khanna, and I am Senior Director Programs at Impact Investors Council. We are an industry body to increase the flow of impact capital for India, and this is our second session as a part of our campaign From Awareness to Action, Advancing India's Climate Finance Agenda. This initiative has been supported by Neev funds. Our objective through this campaign is to educate and align the industry on some of the concurrent issues in climate finance. If the registrations for today's session are a measure of the interest, I would say that we've picked up something very relevant for the industry. We have close to 350 registrations for today's session, and we have the most amazing mix of people amidst these registrations. We have asset managers, DFIs, incubators, consulting firms, legal firms, academia, family offices, all present here. So this also means that we should utilize the next 90 minutes very well. So this is what the next 90 minutes are going to look like. So we will start with setting the context with the Neev funds and move on to navigate the sustainability disclosures and regulations around the climate risk landscape in India with BTG Advaya. Then diving deep into current regulations under Sustainable Finance Disclosure Regulations with White and Case LLP. And finally, we'll navigate the journey from the perspectives of an asset manager who's Article 9 compliant with low capital. So we have a dedicated 15 minutes towards the end for question and answers, any question and answer the audience might have. And if you have any questions, you can either post your questions in the Q&A section, and we'll see if we can pick it up during the session itself or towards the end when we are doing the Q&A round. Or you can raise your hand as well, but we'll be able to, invite you for asking your questions only in the Q&A section and time permitting. So without much ado, I'd like to invite Ankit Agarwal, Investment Associate, Neev Funds, to set some context for today's session. So Ankit, my question to you is that how is SFDR important for Indian asset managers? What role does it play in terms of expectations from LPs? And I'm asking you this question because I'm aware that, Neev funds have European investors, like both Neev 1 and Neev 2 have European investors. So over to you, Ankit.
Sure. Thank you so much, Ranjana. Just a quick introduction about Neev. Like Ranjana mentioned, the Neev Funds is a impact, climate, and sustainability focused investor. Neev Fund 1 was launched way back in 2015 with the idea of creating tangible social and climate impact. Whereas Neev 2, which we are currently investing out of, focuses a lot more on climate and sustainability. With this, we do have the attraction of having attracted global capital, and especially European investors. What we have understood is that European investors, or for that matter, any climate-focused investor, want to have a sustainable long-term outcome to whatever they are investing in. And the way they look at it is that they want a process basically to be followed, which first involves maybe setting up clearly defined objectives, which they do, and they follow that up with dissemination of the objectives and prospective paths. The third part, which is consistent monitoring through a framework, is something which they tend to struggle a bit with. Maybe I just use an analogy here for just quick reference. If someone wants to get healthy, there are various ways to get healthy. Person A might choose to sort of do a crash diet, but is that really a sustainable long term way of being healthy? No, it's not. Whereas a person B might choose a more long term approach of having a balanced diet combining with exercise, other stuff. So, in the long term, the benefits of being healthy will accrue more towards person B. Now, with this analogy, this is something similar to what the investors also want. They want to create a long term sustainable impact wherein they're not just worried about a few quick wins, but actually creating long term impact. What these investors, when they look at, especially in various geographies, especially at India as well, is that in terms of measurement of impact, there is a certain lack of transparency. And even when there is no transparency, where there is some transparency, the data set available is fairly limited. Now, a few key metrics like having GHG emissions does not mean that you are uh, maybe following a very sustainable approach towards investing. With this context, I think SFDR is a boon for such investors who are looking to create some sort of sustainable impact going forward. The SFDR have a very broad scope and are applicable across market participants, and basically they help distinguish GPs who focus on sustainability through the process of investment decision making, right through the process of investment decision making towards the end. By the time they exit, they help them distinguish themselves. Uh, because a GP following this has to have like two broad categories. One, they need to incorporate sustainability risks as one of the factor during the decision making process, and also have a focus on evaluating principal adverse impacts that are emanating out of their investment decisions on the sustainability factors. This approach focus helps basically or helps to focus towards more sustainable investing rather, and help them distinguish themselves from other funds in the market which are also claiming to be sustainable, and thereby creating a distinction and a broad framework on which broad framework of parameters across which the performance of these funds can be measured. Through this masterclass, I thank first of all the participants, including BTG, Advaya, Whitecase, and ISC, especially for driving this, because it's a great platform for dissemination of information on what SFDR are and how one can include them in their investment decision making framework to follow a more sustainable path, which can then lead to more dedicated sort of focused outcomes, which can help attract even more capital in the sustainable investing field in India. I would also like to just quickly mention our thanks for all the support and guidance to our colleagues from FCDO, the UK government, and SIDBI for trusting us with this responsibility and for their consistent support. Back to you, Ranjana and Team ISE.
Thank you. Thanks, Ankit. This rightly provides us the segue for the coming segment. You very rightly said that what are the kind of you've with your analogy, what kind of risks organizations might have to go through and what kind of strategy they choose for themselves to fit into that kind of manage that kind of risk. So you know but before we go to the next segment, I just want to take maybe 1 minute, just an update for our panelists and audience. So we are currently joined by close to 97 attendees, other than our speakers and all. And I would like to take a minute to announce that our biennial flagship program, Prabhav 2024, which is the largest impact investing event in India, has been launched. So the registrations are currently open, and if you use this barcode, it'll take you to the event site, microsite. The registrations are open, and the current, I think there is a discount code as well. If you use that discount code, that will make you eligible for a 50% discount on the tickets. So I will just pause a moment here. So if you want to just, scan the barcode, and we'll additionally put the details about the event microsite in the chat window as well, in case you want to come back to this later. I think we can take the slide off now. Thanks, Sonali. I would now like to invite Prashant Mara, Managing Partner from BTG Advaya, one of the leading law firms in the country and also an ISE member, to start with an overview. Prashant, we would like to understand in larger detail, what even Ankit was referring to, that what kind of, climate risks the organizations might have to face, and how SFDR can help Indian investors benchmark their practices and attract global capital. And drawing insights from SFDR, what could be the potential future regulations for sustainable finance in India? I have a couple of more questions for you as well, and I think I'll just list them out all for you here because we've received some of these questions from the audience over a period of time as well. So what we also want to understand is that what are the differences and similarity between ESG guidelines and SFDR guidelines? How are they similar? How are they different? And if you could also briefly touch upon climate risk related financial disclosures recently released by RBI. So while it'll take some time for the green taxonomy to develop in India, but how can banks and other financial institutions also better prepare themselves? So over to you, Prashant, with that.
Thank you, Ranjana. And thank you to the IIC team and my fellow panelists as well. Very interesting program and very pleased to be part of it. And fantastic to see the response, which is quite heartening. Just by way of quick introduction, I head up the ESG practice in the firm, but look at ESG from a compliance and litigation point of view. So some of the things I might be saying might look a little too, I don't know, I wouldn't call it pessimistic, but from a liability point of view, but that's because that's the kind of viewpoint or the lens that I come from. Maybe Ranjana, what I'll do is I'll pick up one of your questions which you talked about, which I think sets the stage really well. What is ESG, and how is it different or similar to SFDR? I think a lot has been discussed about ESG regulations in the last 3, 4, 5 years. And my view on this ESG regulations, there was one conference I attended a few years back where they said, can we list out all the ESG regulations? And the honest answer to that even today is that if you start doing that, you'll probably end up, with 1,000 plus, 2,000 plus, countless number of regulations that fall into the bucket of ESG. So I think ESG is kind of a conglomeration of regulations that deal with existing regulations and new regulations that deal with environment, social, and governance issues that apply to a business. These regulations always were there. Quite a few of them were always there. If you look at our labor regulations, you can say that those are S part of the ESG. If you look at our Air Pollution Act, Water Pollution Act, Biodiversity Act, the environmental impact assessments, etc., they were part of the E. And if you look at all the governance regulations from SEBI, RBI, and others, they were part of G. What ESG has done because of the UN guiding principles on business, responsible business, is combined all of these and given it kind of a narrative and telling companies and businesses and corporations and governments, saying that stakeholders are now looking at these as ESG regulations, which will help build a better future for everybody, including the stakeholders in the business environment. So, in a very philosophical way, the way to put this is, I think businesses are going from the very objectivist profit over everything and shareholder, maximization of profits for shareholders to stakeholder management and maximization of benefits for all the stakeholders and not just the shareholders. And the two are being linked. That's the ESG world within what we operate today. The main difference is now with the ESG world is what used to be good to have, principles of good business, have now become mandatory principles of business. That's the way you must conduct your business. The perfect examples are all these climate change, climate transition laws that are coming out, including the latest EU deforestation regulations that have come out. So they have become mandatory, and non-compliance has liability both for the corporation, but also in certain cases, like in France with the duty of vigilance, for example, and the duty of care, the liability can also go to the directors who are responsible for this, right? So mandatory and mandatory compliance of some of the ESG laws and disclosure and liability if there's no compliance. That's one part. But what is more interesting, and this is where SFDR comes, what is interesting is disclosure. There's a whole, almost a new jurisprudence being developed on what needs to be disclosed from an ESG perspective. And that is where SFDR is coming in. Disclosure, if you see, started off with voluntary disclosures. It started off with consultation papers. Now it is becoming mandatory disclosure. And the RBI's climate standard disclosures are also similarly, being phased and introduced in a phased manner. The BRSR is being introduced in a phased manner. So SFDR is one such disclosure requirement in the E bracket, the environmental climate change bracket, right? And that's where SFDR fits in. And there is mandatory disclosure under the SFDR regime, and there will be potentially mandatory disclosure in other regimes in other parts of the world. Now, if we look at disclosure, and I'd like to read a sentence from the SEC chair, Gary Gensler, who says, our securities laws lay out a basic bargain. That basic bargain is that investors get to decide which risks they want to take, so long as companies raising money from the public make what is called as a complete and truthful disclosure. So that's the basic bargain. That's the contract, the social contract between the people who are investing and the people who are taking the money, the funds, the banks, etc., and then they're managing those investments. And that's a large part of this audience today, right? That's the contract that you have, and that's the basis of the law. The complete and truthful disclosures is what SFDR is aiming for, is what BRSR is aiming for, is what the RBI climate risk disclosures are aiming for. And why is this becoming much more important than before? If you see the chart that is there in front of us, from 2014 onwards, there are some real physical risks of climate change. The risk magnitude is a curve that goes up from 2020 and gets into physical risk mode in 2040. I just read a report saying that Bangkok may have to significantly redraw their city map because of rising sea levels. I'm sitting today in Ballad Estate, which is very close to the docks in Mumbai. And I have a 9-year-old daughter. And I don't know whether this part of Mumbai will still be accessible in 2050 or 2070 when she is working, right? So these risks that are there in the future have to be first priced in to the investments today. Then there has to be sufficient pricing mechanisms built in to avoid these risks or to try and mitigate these risks in the future. And that's where, if we go back to the first slide itself, and I'll move to the next one. So that's where, that one, thank you. And that's where I think we are seeing the SFDR and regulations like SFDR looking into pricing these risks. And now if we move to the next slide, please. The way that the risk and liability flow down is being done via these regulations like SFDR is it's following the money, right? The pools of capital are anywhere, like Neev said, Ankit said, it's in Europe or the US or even in India or Japan. Along with those pools of capital in the investment agreements, you have these disclosure requirements coming in. You have mitigation requirements, you have audit requirements, and you have requirements to remediate and build resilience in all those investments. And then you have homegrown regulations as well. These homegrown regulations are those that are there in India, for example, the RBI regulations, you have the BRSR. And what funds and asset managers and banks and other investment market participants will have to do is integrate all of these requirements into their investment strategies, into their agreements within their projects and entities. So the clauses in the investment agreements will now have to deal with these. Capacity building has to be done, governance structure has to be built, and audits and remediation have to be done. So these are not rocket science, these are not completely new to our world, to the investment world. We used to do these for other risks. We have done this for political risks. We have done this for financing risks. We are now doing it for climate risks. And the challenging part of doing it for the climate risks is two parts, according to me. One is the scientific basis of these risks is still being debated, it's still being discussed, and it's still being researched. So if you look at the scientific basis of a product lifecycle management, We don't know, for example, in the EV world, what is the impact of battery and a used battery in the long term on the environment. So how do you actually say that an EV battery is better than diesel 20 years down the line, 40 years down the line, or 100 years down the line, when there are millions and millions of EV batteries and you can't dispose it, right? So the challenge today for pricing those risks, not even pricing, let's say identifying the correct risks, then mitigating those risks, and then pricing all of that is the moving scientific goalposts, which will continue to move. So that's the challenge I see. But otherwise, risks and liability flow down is something that I think we're familiar with. If we move on to the next slide, please. What does it mean for you? I think it means more oversight. It means board and partner level liability, reporting requirements at the portfolio level and the entity level, pricing, insurance, other pricing mitigation measures, and then a question of right now attracting better capital versus losing out. I've just read that despite all the promises in COP meetings, this 7 trillion that has been still invested into fossil fuel companies by the world's biggest banks. Now that is going to start reducing, and when that happens, I think funds and investment managers and asset managers have to be ready to attract better capital out there, which is looking at climate risks and climate change mitigation measures very seriously. My last slide is about the RBI's draft disclosures on climate risks. It applies to regulated entities. Right now, this does not apply to investment funds and alternate investment funds. These are the entities that it applies to. And the timelines are given. I won't go into the timelines because I'm conscious of time. Quickly moving on to the next slide. Thank you. The RBI's draft disclosure looks at 4 pillars, the 4 pillars of the disclosure framework. One is governance. So what kind of entities are required to disclose what kind of information and who's responsible for it? So the board, the senior management roles, the committees within the boards, what kind of reporting requirements are there? All of these come into governance. Then you'll need to look at the strategy for investment. Are my investments climate risk proof as much as possible? And you have to identify the risks and the opportunities and the impact assessment. Once you've identified the risk, the third pillar is risk management. You focus on the procedures, recognizing and evaluating those risks into your investment framework, into your management framework once those are integrated. And finally, you have the metrics and targets for reporting, which goes back to governance, right? It ties back into the governance, KRIs, etc., that need to be then reviewed by the boards and the senior management and then reported back to the government. So where we are heading today, and I'll stop there and hand over back to Ranjana, is a very clear indication that climate risks are top of the list in terms of materiality of risks. And governments all across, starting from SFDR and CSDD, which Lavanya and team will talk about, have clearly identified that these risks need to be disclosed and efforts need to be made to make sure that these disclosures are not wrongful disclosures or suppression of facts. Greenwashing has become a big liability issue world over. And then finally, for the investment world, these risks have to be factored into from a pricing perspective. Back to you, Ranjana, and then happy to answer any questions in the Q&A round.
Thank you, Prashant. I'll just step in here. So to introduce myself, my name is Divya and I lead the research initiatives at IIC. Extremely helpful insights, Prashant, especially the part where you spoke about how the regulations are now aligning and talking to each other. There's one quick question that I had. Would it be appropriate to say that while SFDR gives a broad, a global framework, every country would now have to adapt it to their country-specific risk or the technology risks based on what we are observing happening in each space? For example, you spoke about EVs and batteries. So the nature of risk or the pricing associated with it in India may be very different from how it's there in other countries.
Absolutely.
So would it be more about adapting those global frameworks to the risk specifics to the country?
Divya, that's a very good question. In fact, I'll take the EV example itself because it lends itself really well to the answer. You look at, India is going through a phase where EV is becoming the next thing to do, and I am actually fighting a writ petition right now, where about 32 different cities have banned petrol vehicles. Right now, one of the arguments we put forward to the court is, where are these EV cars being charged? Right, they're being charged from our existing grids, electricity grid. Where is this electricity grid drawing its electricity from? It's drawing it from the mostly coal-powered power plants, right? So you're actually shifting climate risk from, let's say, diesel to coal. Which one is better or which one is worse? You don't know. You don't have the scientific evidence to prove that, right? So by taking these snap decisions like that, saying EV is better, and let's all buy EV cars, we may actually not be achieving what we want to achieve today, at least, right? So that leads to the answer to your question. Not only will each country have to kind of create its own framework for identifying these risks and pricing these risks, I think it's very much sector dependent. It is very much industry dependent. It's even dependent locally. For example, in your own city, if you have solar powered roof plants, then it may be better to encourage EV deployment there, because you're drawing the power from your rooftop rather than from the grid, from a coal power plant. Sorry. So yes, the answer to your question is absolutely yes. It has to be much more. I think this SFDR and CSDD, they'll give broad guidelines. Each country, state, city level nuances have to be brought in.
Got it, Prashant. And just to sum it all up, so basically, when the green taxonomy, if and when it does come in India, that would be an important point to keep in mind while you're deciding what part of your investment aligns with which part of the green taxonomy, and what would be the pricing or the risk impact of it.
Absolutely, and see, this is where I disagree a little bit with the European approach to green taxonomy, right? I mean, what applies to the global north in terms of the taxonomy is probably not all relevant to what applies to the global south for green taxonomy. And which is where I think IISc and these discussions should create more awareness about the fact that we need our own taxonomy system, which then we will implement based on the nuances that we have.
Thank you, Prashant. Extremely helpful. You brought out the difference between the global north and the global south. I think that's exactly what we like to learn from White & Case LLP now. But before we proceed, thank you very much to you and the BTG Advaya team. Extremely helpful in just putting together and curating this masterclass.
Pleasure. Thank you.
Thank you. So like we've learned, SFDR, ESG compliances, everything aligning with each other, talking to each other. We'd like to now get into understanding the depth of what SFDR truly entails. And for that, we're very glad to have with us today the team from White & Case LLP, an international law firm with deep expertise in investment management and sustainability matters. I would like to welcome Chris McGarry and Lavanya Raghavan, partners at the firm. We've just understood the relevance of climate risk frameworks that Prashant spoke about, and how India needs to adapt to it now. There are a few questions which we thought the audience would really benefit to understand from you, especially as most of them are asset managers and speaking to international investors who are looking to deploy capital in India. So, Chris, Lavanya, a few points that I'd like to just put across before you proceed, with the deck that you have. In the international context, what is the relevance of SFDR? How are investors viewing it? What were the key objectives or the scope behind actually institutionalizing it? And what do each of the articles of SFDR really entail? In terms of asset managers, what are the specific disclosure requirements? Maybe if you could kind of zero in on the most critical ones in your opinion that you are observing. And just when we speak of the overall investment landscape, sustainable investment landscape in the global arena, how is SFDR driving this conversation? So a few primer, to just before we get into the discussion, and thank you for being here. And with that, we leave you to explaining, demystifying SFDR for all of us.
Thank you, Divya. Those are excellent questions, and a number of them are going to be covered by the slides, some of the more granular, detailed ones. But on your first question, to set the context behind the SFDR and the EU Green Deal more broadly, the SFDR is a key component of the EU Green Deal. The overall intention of the EU Green Deal is very deliberately to provide for global regulation. So the EU, in considering the approach to the issue, first and foremost, they've said they've been absolutely clear in Recital 1 to the CSRD, the Corporate Sustainability Reporting Directive, that the EU Green Deal is the growth strategy of the European Union. So that goes to a point Prashant mentioned, that this is this move away from Milton Friedman's shareholder primacy as a concept to stakeholder primacy. And it's also the mechanism by which the EU is intending to satisfy its treaty obligations around the UN Sustainable Development Goals. And then in terms of deliberately being a piece of global regulation, the EU considers itself, I think rightly, to be the only economic and political body that has the necessary will and means to provide for meaningful global regulation at this point. In the US, obviously, it's a political hot potato with the election coming up. But in terms of effectively implementing or acting as a kind of global regulator for these issues, there has to be some meaningful nexus with the EU. So that's perhaps a good way to segue into our slides. And by way of just brief further introduction about what I do. So I'm a partner in our capital markets practice. I'm also one of the founding partners of our sustainability practice in 2020. Lavanya, who I'll pass over to in a few minutes, is a partner in our private funds practice. So she'll speak more to some real-time examples in the fund space. But if we can move to our slides, please. And we will mainly focus on the SFDR, but we're also going to mention a couple of other parts of the EU Green Deal, because you have to think about the EU Green Deal holistically. I can't see our slides yet.
Sure, we'll just pull them up.
Right, if we can go to the next one. Next one. Okay. Oh, sorry. Yeah. Okay, that's fine. Well, I can work with that slide that's on screen now. So the SFDR in overview is doing three main things. It defines what it means to be a sustainable investment. And Prashant touched on some of this, that, for quite some time, we had lots of voluntary initiatives and, lots of participants up and down, economic chains moving towards sustainability. The issue of greenwashing was also mentioned. So it's been difficult for investors and other stakeholders to invest with confidence when they're investing in something that was, based on some subjective or voluntary standards. So the SFDR now defines what it means to be a sustainable investment, and we'll go into that in some more detail. The second thing it does, and this goes back to Divya's question as well, and a question that will be on many of your minds on this webinar today, is who does the SFDR apply to? And the answer is a somewhat narrow one, because it only applies to financial market participants and financial advisors. I'll explain what those two things are in a moment. So it defines sustainable investment. It applies to financial market participants and financial advisors. And for financial market participants and financial advisors who are in scope, it creates a mandatory framework of sustainability disclosures. And then the third thing that the SFDR does, which is probably the most interesting thing in some ways for the audience today, is it creates a voluntary disclosure framework for two types of sustainable investment funds, Article 8 funds and Article 9 funds. To be absolutely clear, those are both voluntary things. If we can go to the next slide, please. And the next, oh, okay, great. So financial market participant, it's a slightly longer list of things, but the main two types of financial market participant are investment firms, which provide portfolio management services. And investment firms are large asset managers regulated under the EU's MiFID directive. And then the second type of financial market participant, perhaps more relevant for this audience, are alternative investment fund managers, which manage or market AIFs in the EU. So if you're marketing your Neev fund or other similar funds to EU LPs, then there's the possibility to come in scope via that route. If we can go to the next slide, please. Okay, so I mentioned the three main things that the SFDR does include, first, defining what it means to be a sustainable investment. And the two, you're either an environmental, you either have an environmental objective or a social objective, or quite possibly both. Just on the both for a moment to set some context. When the UN was developing its sustainable development goals, they are all interrelated, the 17 goals. And of course, SDG 13 is on arresting climate change, but it interrelates to the sustainable development goals on economic activity, and then also on the social side on equality. And just to give a couple of data points to set the context there, and it's been touched on this critical distinction between global north and global south. There's also a significant gender overlay or gender lever in which women face more risks from climate change than men. And an example that's often given for that is on the textile industry in Bangladesh. If we look at those 17 sustainable development goals globally as well, they are audited each year. And the three countries that are closest to delivering across all 17 sustainable development goals are Finland, Denmark, and Sweden. And they are also, no coincidence, the closest to delivering on gender equality. And if we go in the other direction, if we look at a statistic, for example, of the 20 countries with the lowest GDP per capita, they include 17 of the 20 countries with the highest rates of child marriage and FGM. So when we're thinking about sustainability, the EU certainly views it holistically. And so you can have a narrow focus on an environmental objective. You can have alternatively have a narrow focus on a social objective. And if you're in an environmental objective, that's defined more specifically in the EU taxonomy regulation that's also been mentioned. But then you'll see the proviso at the end of this slide that when you have an investment strategy that's targeting let's say an environmental focus, you also need to be cognizant that you're viewing this sort of holistically, and that what you're doing is not having an adverse on other sustainability factors. If we can go to the next slide, please. Okay, so Article 4, I mentioned that there are some mandatory sustainability disclosures for FMPs and FAs that are in scope. And we haven't set out the financial advisor definition on the slides, but it includes insurance intermediaries and managers of UCITS funds, as well as investment firms and AFIMs as well. Just mention that for completeness. So for smaller FMPs, there's the possibility to say that the financial market participant does not consider adverse sustainability impacts. But if that decision is made, then there needs to be a clear explanation of how that decision was reached. Under Article 4.3, for larger financial market participants, so all the banks in Europe, for example, and large asset managers, any of those entities that have over 500, sorry, not over, have 500 or more employees at their annual audit date don't have the choice to say that they don't consider sustainability impact. So that's the EU, providing a de minimis threshold, but for larger institutions, that's not a choice. The EU saying if you're a large bank or asset manager managing, tens of billions, hundreds of billions, trillions even, it's not a possibility. It's not realistic to say that having an investment portfolio like that has no potential, adverse sustainability impact. Under Article 6, FMPs marketing any sort of fund product, so any fund with LP investors coming in, you need to specify in the pre-contractual disclosure the manner in which sustainability risks are integrated into the investment process. So, what due diligence is the manager doing? Now, you have to do that even if the overall objective of the fund is not ESG focused. If you're investing, the fund strategy is in an area where the sustainability risks are unlikely to be significant, there is the possibility to explain how that decision has been reached. If we can go to the next slide, please. Yeah. Okay. So moving on now, we've got to the voluntary part of the SFDR. So Article 8 and Article 9 were adopted with real enthusiasm in the first couple of years of the directive coming into force in June 2021. Article 8 is sometimes referred to as lighter green, and Article 9 are the darkest green. To one of the earlier questions, Article 8 is an incredibly broad church, and I'll come back to that in a moment. But the point was mentioned earlier on, and I touched on it as well, that it's critical in the development of a sustainable investment market, and more fundamentally to that, to actually achieving the objectives of sustainable investment, including the energy transition and what I call the equality transition. It's very important that investors have a clear understanding of how the fund operates. And so the pre-contractual disclosure framework for both Article 8 and Article 9 is intended to make it very straightforward for investors in minutes, frankly, to have quite a good sense of the sustainable objectives or the sustainability profile of the fund. And so the templates developed by the EU to facilitate this on both the pre-contractual disclosure and then the periodic reporting, which investors then receive over the life of the fund. They're very simple, short templates, and so they don't allow for a lot of subjective creative writing. Though there is quite a high degree of subjective choices made within an Article 8 fund as opposed to an Article 9 fund, and I'll come back to that in a moment. But for Article 8, an Article 8 fund, it doesn't need to be exclusively sustainability and ESG focused. And so, as I mentioned, in the first couple of years, the fund management universe in Europe adopted these voluntary Article 8 and Article 9 frameworks with real enthusiasm. So Morningstar Research estimated that as early as the end of the end of last year, over 50% of the over 55% of the AUM in Europe was committed to Article 8 and Article 9 funds. And of the two, Article 8 and Article 9 combined, Article 8 represents about 95% of that AUM. So Article 9 funds are a much smaller part of this SFDR investment universe. And that's reflective of the dearth of investment opportunities to date. Can we go to the next slide, please? So I've already mentioned the simplicity of the pre-contractual disclosure and periodic reporting templates. You know, these templates are a few pages long, and in the first cell on both, or in the first cell of the pre-contractual disclosure, there's the first two cells, there's a short explanation of what the sustainable investment strategy is. And if you're Article 8, in the first box on the form, you need to say if sustainable investments are part of the investment strategy of the fund. Now, what I just said might sound mystifying. How can you be an Article 8 fund and not have a sustainable investment as part of the objective? And the answer to that question is that I mentioned Article 8 is this incredibly broad church. So at the lightest green end of the spectrum, and by the way, I'm saying green, you can be an Article 8 social fund, but you know, I think in general, people are used to using the word green to mean sustainability more broadly, including social. So at the lightest green end of the spectrum, it's sufficient to have an exclusionary screen only. So coal was mentioned. In my day job, one of the products I work on are CLOs, which are funds in rated securitization format that invest in European and US non-investment grade companies. And those transactions in Europe now, it's 100% of those transactions since 2021 have an exclusionary screen, for example, that doesn't permit investment in coal, which was mentioned. So, but investors are not seemingly motivated by an exclusionary screen only. So you can go exclusionary screen only, but on the first cell of the pre-contractual disclosure, there's a box that if you were only doing the exclusionary screen, you would enter a cross in the box to say that you don't have sustainable investment as an objective. So you're screening out certain industries, but you're not positively investing in an asset, in a business that is looking to advance one of those environmental objectives as defined under the taxonomy regulation, or one of the social objectives. So if you put a cross in the box of an Article 8 fund and say you're not doing sustainable investment, then from our experience in the market, that investors are not going to be motivated by that. You're probably not going to attract new LPs if you're going with the kind of lightest shade of Article 8. And then, so if you're a darker green, and it's a very broad church, as I said, to make the distinction between the darkest green Article 8 and then what it means to be an Article 9, if you're a darker green Article 8, you would check the box and say, sorry, please, can we go to the prior slide still? If you're a darker green Article 8, you would check the box and say, yes, I do have sustainable investments as one of the investment strategies of my fund. And at the darkest green, and this is a non-real world example just to make the theoretical point of the breadth, you could say 99.9% of the assets that this fund will invest in are sustainable investments. Now, clearly that's, if you were going to go 99.9, you would just go full 100 and be Article 9. But so you have exclusionary screen at the lightest end of the spectrum. At the darkest green end of the spectrum, you would be almost 100% sustainable investments. And in reality, of course, the Article 8 funds that have, that attract investors are somewhere in the middle of those two things. And they're quite often referred to as Article 8 plus funds. And when you hear people talking about Article 8 plus, they mean an Article 8 fund that includes a minimum level of sustainable investments. If we go to the next slide, please. So I've already probably sort of covered this, but if you're an Article 9 fund, and again, much smaller, only about 5% of the total Article 8, Article 9 universe is an Article 9 format. That means, and quite possibly, and we're going to hear more about, from the other participants on the call about an Article 9 fund. But if you're Article 9 fund, then the only thing the fund invests in is our assets that have that qualify as sustainable investment as defined under the EU definition. Go to the next slide. Yeah, so I haven't mentioned before, but there is, if you are using an index, and the indexes that we're thinking about here do relate to greenhouse gas emissions. So there are different indexes operated, but for you know, borrowers in different parts of the world, etc. But you can reference an index and then say how the fund's investments are aligning with that index, or you know, doing better than the index. The split between Article 9 and Article 8 funds in the last 2 years has grown more in favor of Article 8. So some of the funds that in 2021, 2022 were launched and did their first closes as Article 9 funds, over the last 18, 24 months, some of them have voluntarily changed into Article 8 plus funds. And again, as I mentioned, that's reflective of the dearth of investment opportunities. If we can go on to the next slide, please. Okay, so under Article 19 of the SFDR, the EU Commission, by the end of 2022, had to do an assessment of the efficacy of this regulation. Now, the Commission and the EU Green Deal more generally has been, some aspects of it have been delayed. And while, as I mentioned, recital 1 to the CSRD says the EU Green Deal is the growth strategy of the European Union, and in the immediate days after the invasion of Ukraine, Ursula von der Leyen was very clear that you know, the issue of energy security, etc., wasn't going to derail the EU's focus on sustainability as its core policy objective. So that was made very clear. And in fact, Ursula von der Leyen said it accelerated the need for the energy transition because, you know, the EU was overly dependent on Russian hydrocarbons. So the timetable, though, notwithstanding that, since those initial remarks, you know, competing policy objectives of security and energy security have slowed down the implementation on the later parts of the EU Green Deal. And, you know, it's certainly more of a US issue politically, the anti-ESG lobby, but it's election year. You know, obviously we have the US elections later this year. It's election year in a lot of the key EU jurisdictions as well. And there's certainly been a shift in the political will in the EU, slightly away from this laser-like focus on the EU Green Deal. So that commission evaluation, it has effectively been somewhat delayed. And there was a public consultation that concluded at the end of last year. And the commission, you know, following feedback from the market and other interested stakeholders, is considering further the efficacy of the SFDR. And if you like, and then I'll hand over to Lavanya before then taking the mic back to talk about other bits of the EU Green Deal. But in a sense, the EU got the implementation of the Green Deal in a kind of back to front order. And, you know, I guess the reason for that, maybe there are two reasons for that. I mean, on all of these issues, we had, you know, political consensus emerging, then market consensus. So the EU implemented the market part of the EU Green Deal first. But then, as I mentioned, the dearth of investment opportunities has limited the impact of the SFDR in some respects. So the later parts of the Green Deal are going to make it mandatory for a lot of businesses to effectively be sustainable investments. And if most of the investor universe is a sustainable investment, then the need for an Article 8 and an Article 9 fund diminishes. But I will pass over to Lavanya now to talk about some you know, recent market examples of Article 8 and Article 9.
Next slide, please. So, hi everyone. As Chris mentioned, I'm a private funds lawyer. So my day-to-day job is working with private fund managers as well as investors into private funds. So we see a huge range of the market. We see what the managers are doing, and we see the things that investors care about. So, with the caveat that I'm not an expert on SFDR, I thought it would be really helpful and perhaps interesting for you to hear about what we are seeing in the private fundraising market when it comes to SFDR. So obviously, for managers, whether sustainability focused or not, they've had a few years where they've really needed to get up to speed on SFDR and understand where they want to position themselves and their products, in accordance with the classifications that you've just heard more about from Chris. Now, when SFDR first came into the picture, from a fund marketing perspective, everybody thought, well, let's just go for the better option, whatever it is, an Article 8 and now, we've seen a slight change in the market because there's been a better understanding of what it means to sign up to these levels of disclosures. There's a better understanding of what investors want. And there's also a better understanding of, the risks of, saying something that you're not going to do, i.e., greenwashing. So, we've had, managers who wanted to be cautious and conservative, who started out, with just the Article 6, and then over time have kind of made the move up. We've also seen, the reverse, where, people who've originally started out or thought, they were in Article 8 or Article 9 terrain, actually, the disclosure and, just the framework around it and, what they can provide, and we'll kind of get a little bit more into some of the challenges that we see managers with, is more actually aligned with, dropping a level down and, being a bit more measured in what you're saying. I think from our perspective, the advice that we always give clients who are managers is to really, really be very sure of what you are saying, and to make sure that, when you are providing these kind of pre-contractual disclosures, whether in the PPM or otherwise, that you can really stand by those for the duration of the fund. Because it's one thing to say something when you're trying to market and sell your fund, and it's another thing that, on an ongoing basis, you're signing up to obligations that are going to span, the life of these products. So you should be able to stand by them and make sure that you have the systems and the frameworks and the processes and procedures in place to help you comply with, the things that you said you would comply with. Again, Article 8, Article 9, I think Chris has kind of touched on it already. I think the point here that we wanted to make is that Article 8 is really a broad spectrum. And Article 9, we see kind of fewer of in the market precisely because of some of the reasons that, Chris has clearly mentioned, the thresholds of what it is to say that, you're focused exclusively on sustainable investments. And then dealing with investor perceptions, obviously there has been a sea change, investors from these classifications and these types of products being nice to have, we are now seeing investors make capital allocation decisions based on, wanting or having a certain bucket that's earmarked for, could we just go back to the previous slide, please? Yeah. So investor perceptions, but the other interesting thing, and this is very much an exception to the rule rather than the trend that we're seeing, is there is also predominantly in the US with some of the red states, there's also an anti-ESG sentiment, and we sometimes deal with the larger managers who are seeking to raise capital both in the US and Europe, and there is a kind of a small percentage of the investor base that they're seeking to attract that is actually wanting something that's quite different, and in fact even at odds with what, let's say, more ESG minded investors in Europe are. So it's also kind of worth noting that on occasion we have kind of come across that issue as well, which is very interesting, I suppose. And then for managers, this is all about disclosure. So, and a lot of the challenges for the managers, especially the smaller managers, comes in the form of data, getting the right data points, having access to the data, and also the kind of the credibility and the the finality of that data. A lot of times data is based on estimates, it's coming through different channels, the methods of collection of that data, and therefore, and the methods of representing that data. All of that we are seeing has been a huge challenge for managers, especially the smaller managers. We'll look at it from the investor's perspective on the next slide. But one final point that I wanted to touch on is, the idea of sustainability and, impact-focused funds is not new. It's predated SFDR. We've had many funds and many managers who are in that space. And we've always had, impact funds, for example. And impact funds, in my mind, are not just the funds that are saying that, look, we're doing these things, we're screening for these types of investments. We are making sustainability is kind of a big focus. We're also increasingly seeing funds that are not just saying and doing that, but truly that are measuring that impact, that are taking economics, or calibrating their economics, their carry, their performance, etc., on the attainment of certain impact goals. And those impact goals, again, the metrics of measurement are varied. There are many. They're not always harmonized. And so there is that universe of impact funds, which, well, Article 8 or Article 9 is a bit moot. What they've been trying to do for a long time is do something different and, go above and beyond in actually achieving and demonstrating returns that are, derived from sustainable investments. So those are some of the things that we see and we talk about when we're advising managers. And if we can move on to the next slide, please. I mentioned that, we have quite a balanced practice. We often work for, and of course, always work with investors investing in the private funds. And, Chris mentioned that, Article 8, Article 9 is, it's a voluntary regime. And, when and the sophistication level of the investor and their understanding of SFDR, of, sustainability, of ESG-related considerations lends itself to, how they view your product. I mean, for the smaller investors, the less ESG-minded investors, they will kind of take it at face value. You will see you're saying you're an Article 8 fund. That's great. That checks a box for me. I wanted to allocate capital to an Article 8 or Article 9 fund, and that's great news. But to the more ESG-minded requesters, often they've got their own criteria for assessing, whether this meets their standards. They've got very often, and for those of you who are capital raisers and who are at emerging markets, you are at funds, and you are very often used to seeing DFI type investors, which we see often, and we work with them often in funds focused in different parts of the emerging markets. They have extraordinarily detailed and well thought through and really long-standing requirements on all types of ESG considerations. They have their own metrics, they have their own reporting formats, they have their own requirements. So for some of them, this doesn't really move the needle. They've been sophisticated enough in thinking through all of these things and working with investors to really measure and achieve impact in a different sense. And again, the reporting provided under SFDR, I mentioned some of the challenges with the data. And also from an investor's perspective, it's the comparability of the data. There are different types of reports, there's different types of metrics and measurements. And well, how does one reconcile this type of reporting, this type of disclosure that you're getting periodically under the SFDR with other things that you may want or have, or other kind of more granular impact assessment metrics out there. And I mentioned, the investor reports. Many investors have their own form of ESG and similar reporting. And I guess on the investor piece, I'll close off by saying, the SFDR is very much viewed as a disclosure regime. You're reporting on several things on an annual basis. And as I mentioned, from many fund investor and fund managers' perspective, especially those who are looking more at impact and seeing, well, what kind of actual tangible, how can we quantify that impact that you say you're bringing about in your portfolio companies? How can we quantify that impact? The more impact-minded managers and investors are really looking up for metrics to evidence attainment of that impact. And I mentioned, for managers, we are now seeing managers who are, putting their money where their mouth is and saying, well, if these kind of tangible impact goals and metrics and numbers are not met, we're not going to take that portion of our carry, etc. So, yes, to just make that kind of distinction between, yes, we are alive to something, we will disclose to you how we're taking these considerations into account in our investment decisions. We will disclose to you on an annual basis all of these things, and just taking that a step further and saying, well, I am focused on impact, and I'm focused on generating returns as well, and how you quantify that. So I will leave that with you, and I'll hand it back over to Chris to talk about some other relevant developments.
Thank you, Lavanya. And I'll do this last bit very quickly so that we've got enough time for questions, but it's important to give you the full picture. So if we can go to the next slide, please. Yeah, so the CSRD became law last year, but it will apply to companies with listed equities in Europe. This is the first financial reporting year for it, and they've got to deliver their first CSRD report next year. And then 1 year after that, private businesses, their first year under the CSRD will be 2025, and deliver their first CSRD report at the same time as their financial report in what are referred to as integrated reports by end of June 2026. Next slide, please. So I mentioned this in my prior section. Well, two things I've touched on already. So it's obviously, to be global regulation, the EU is only capable of doing that if the businesses or investors have, there is an EU nexus. But you'll see here on the slide that it's a relatively low level of EU nexus. So on the third bullet in particular, so only 150 million euro of revenue in Europe may be sufficient to, or will be sufficient rather, to bring a non-EU business in scope for CSRD. Next slide, please. Yeah, so just to give you a flavour here, and why, as a potential output of the SFDR review, we may see some changes, or we may see Article 8 and Article 9 diminish in sort of how attractive they are. These are very profound obligations on businesses that are subject to the CSRD. So mandatory requirement to have a Paris Agreement transition plan. We don't have time to go through all of these things, but these are significant. On bullet 3, and again, it's talking about stakeholders. So as a matter of law now, it's no longer shareholder primacy. As a matter of law, it's stakeholder primacy. And in the CSRD report is audited as well. Point 5 is quite an important one. That there's got to be a lot of internal upskilling, and there are obligations at the board level. Prashant already referred to a specific earlier French adoption of that, and the penalties for non-compliance need to be effective, proportionate, and dissuasive. If we can go to the next slide, please. So the CSRD is already the law. And it has some, significant. It's not just a reporting regime. It's a really important point to stress. Contrast that with the the SEC's new rules. Under the SEC's new rules, if you have a Paris Agreement transition plan, you disclose it, but you're not required to have a Paris Agreement transition plan. So another part of the kind of recital of the EU Green Deal overall is another example of the paradigm shift. So the EU has looked at these issues and said, we only achieve the energy transition, equality transition by co-opting private businesses globally in the delivery of treaty obligations. But then the CS3D, which is the final part of the EU Green Deal, and this really is an example of this slight shift, and maybe it's a shorter term shift in focus in the EU because it's election year, etc., and because of the continuing impacts of war and security and energy security considerations. But as we saw on a prior slide there, 150 million of turnover in the EU is sufficient nexus under the CSRD. That 150 million was going to be the same number in the CS3D, but in the final political wrangles in December and then again in April this year, that got changed to 450 million of turnover. So it's a bit of an odd situation where, really large global businesses, it doesn't make a difference. They're in scope under both rules, but we will see this smaller subset of businesses that are subject to CSRD, but not subject to CS3D. The obligations are it's not just identify where the business it has adverse impacts or faces the risk of climate change, etc. But having identified those risks, you actually need a measurable action plan, and then this works with the CSRD because you get audited against your action plan each year. So the end destination under CS3D and CSRD is to be fully sustainable as businesses. If we can, I think that's the end of the slide, but that's just to mention the penalties again, and Prashant touched on penalties already. So penalties, it's both enforcement action by EU member states, and business can be fined 5% of their global turnover for non-compliance. But there's also civil liability and emerging jurisprudence, already emerging in Holland, for example. Any citizen of the Netherlands had standing to make a claim against Shell for climate change. On EU-wide, any global businesses that are failing to discharge their CS3D obligations, could face civil litigation, including class actions. So I think that's probably it to allow for questions. So I will pause there.
Thank you, Chris. Thank you, Lavanya. I think that was a very detailed discussion around what SFDR really is. We do have a few questions on the chat, which we'll get to in a bit. But before we go that, I'd like to just move to our penultimate segment, which is about speaking to the asset managers and just getting their perspective on this entire concept. So we've heard from the legal experts. What we'd like to now do is move on to understanding what the asset managers are perceiving SFDR to be and how have they gone through the implementation. We have with us one of the foremost impact investors in the country and also the founding member of IIC, Lok Capital. Today, we are glad to have with us Vikram Dileepan, Director, and Anmol Saxena, who manages their ESG and impact practice. Before we get to a few questions, Vikram and Anmol, if you could just give a quick introduction to yourself and maybe a quick primer on what Lok does and how has been your SFDR journey till date.
Thank you, Divya. I think this has been a great initiative put together by IAC. For the context of the larger group, Lok is an impact investor for the past 20 years. One of the funds which has, along with the other pioneering funds in the space, started investing first in microfinance. And we have, over the past 20 years, invested in various companies in financial services, agriculture, healthcare, and now we are also investing in climate technologies. We are also one of the first few funds who have successfully exited our first couple of funds, the first early 2 vintages, and now we are on our 4th vintage. It has been also our pleasure to introduce SFDR 9 and be one of the first few compliant funds in India. Anmol can add.
Thank you, Vikram. Thank you, Divya, for the introduction. As Vikram mentioned, we are happy to be a part of this session and happy to take up any questions that might come. Vikram is a director at Lok, leading the climate strategy for Lok Capital. And I look at ESG and impact across the fund and have led the SFDR integration with the ESG management standard of Lok Capital. Happy to move to the questions, Divya.
Thank you, Anmol. Thank you, Vikram. So like you mentioned, being one of the first funds that became article compliant, could you kind of break it down for us and for the audience? What does Article 9 compliance really mean in practicality? Does it mean realignment of what the existing processes you all were engaging in, or does it just mean kind of reorienting it to what Article 9 requires?
Sure.
Yeah,
Go
please
ahead.
go ahead. Okay. So being Article 9 compliant was, it signifies a major commitment to disclosing certain parameters, as has been mentioned by the previous two speaker panels as well. So for us, what it meant was, first step was to define what sustainable investments mean for low capital. The genesis of low capital has been social inclusion. That has been a genesis since 2004, but it was putting more thought and structure to definition that we worked on. As Article 217 of the SFDR says, we have to define sustainable investments. So we went ahead with the definition of sustainable investments. Article 9, being one of the darker green funds, as Chris mentioned multiple times, also required us to share how much capital allocation would go to the various objectives that are further there within the definition that we use as sustainable investments. So we went ahead and gave more detail about that allocation of capital. And after it was more about creating a first climate framework, because we already had a ESG management standard, and for low capital, the idea is to be ahead of the curve when it comes to ESG practices. And given we have had a lot of support from the DFIs as well that we would, and also the commercial investors have shown interest in products which are more Article 9 aligned. So for Low 4, the fourth fund of low capital, the idea was to be Article 9 aligned from the onset. So we devised a climate framework, which then we further integrated into our ESG management standard.
So when you mention about the existing climate framework, Anmol, and how you aligned Article 9 to it, so does this also mean that investors or asset managers could build in the Article 9 compliance around their existing IMM frameworks? We hear a lot of conversation around impact measurement and management and how everybody is developing their own practice. So is this something which could be integrated at the design level itself to align with Article 9?
So at a design level itself, I think that would depend solely on the fund, how the fund itself is, the internal practices of the fund on IMM. So for us, impact measurement was always apart from, even for the earlier low funds, we have been collecting social indicators for all the investments that we make, being an impact investing fund. And for us, it was a step simpler, because we had to introduce the climate framework itself, whereas social and governance things were already in place and in practice at low capital. Okay. So for climate framework itself, since there are particular requirements like scope emissions accounting, scope 1, 2, 3, now that becomes specific and technical. So for that, of course, we had to do internal capacity building as well as knowledge sharing with our portfolio companies. But at the end of the day, it can be incorporated from the onset. That is the strategy for low. But it can also be incorporated later. Probably you will have to go back and do some exercises retrospectively, but doable. Vikram, if you would like to add anything.
Yeah, I think just to add to Anmol, impact measurement and reporting has always been part of our DNA. I think we have been doing it much before the taxonomy came into enforcement. With the taxonomy, it provides a clearer guideline of what impact metrics and indicators to report on, and to also add a certain new paradigm around transition risks, as well as the DNSH and the principal adverse impact indicators. So I think this was probably an addition to what we were already doing to a large extent, and I would presume that would be the case with many of the impact funds who are following this to some extent, but they would have to re-engineer it to suit the SFDR framework.
Got it. So given that, most, like you mentioned, most asset managers are now building this practice, how do they view, how are LPs viewing it? In your experience, when you became Article 9 compliant, or as you were building this practice, does it make LOC more amenable, or what is the feedback you're seeing from LPs? How are they viewing this practice? Do they see it as an added benefit when it comes to, say, viewing the fund from an overall investment perspective? So what's been your experience?
So they welcome it, actually. So because most of the impact capital in the ecosystem has been from DFIs, but considering our financial performance, we have also had a mix of commercial LPs come into our fray. But achieving SFDR enhanced our credibility as a responsible investor, and potentially establishes a relationship with EU-based LPs, much more than what it would have been otherwise. So yeah, I think the demand for Article 9 funds is actually much more than what the supply is in the market, especially considering the LPs operating in the SFDR paradigm.
Got it. And we have a lot of a lot of entrepreneurs, a lot of enterprises in the audience today, Vikram. So from the perspective of an asset manager who is now Article 9 compliant, what are the implications that investing companies need to be mindful of? How can they prepare themselves to become more investable, if I can put it that way, by such funds?
Yeah, I think it is contextual. It really depends on the stage of the firm. Very early stage companies, which usually attract venture capital, I think these companies would not have too much of frameworks around SFDR and ESG in place. But as a institutional investor coming on board, it would be our joint responsibility along with the other institutions to make sure that the promoter team or the entrepreneur team does understand the implications of being SFDR compliant. I think one of the key highlights for them would be that good governance and ESG and SFDR practices do enhance value at the end of the day towards the life cycle of the firm. And I think that is a point that still needs to be understood by the entrepreneurial community as they scale up their firm. And not to mention the fact that this opens up the avenue for them to access capital much beyond the universe that they would have been otherwise used to from the Indian institutions. So when you combine both of these aspects, I think I wouldn't say we are entirely there, but we are doing our bit to educate our portfolio companies as well.
Got it, Vikram. We just have a question coming in from the audience. So with reference to the conversation around SFDR being more holistic, that it also pays due cognizance to SDG 5 and the gender equity angle. How are you evaluating your fund from that lens? So does it mean actually laying down the social objectives and matching it to what it would mean to be gender equitable? Does that also kind of align in the objectives you define?
So if I may take that, low capital, as I had mentioned, had already always been at the forefront of defining certain BIs around social objectives for each of the investments that we make. So most of the investments that we make are in the financial services space, climate tech, agri-tech, health tech space, where we always look at these social aspects as well. And low capital is also Fund 4, is also a 2x challenge qualified fund. So that itself puts us in a place where we are very cognizant of how we see gender playing out in our investments, pre-investment and also post-investment. We dedicated calls with our portfolio companies on seeing, for example, why is there a 3% drop in the ratio of female employees? We would like to dig into that and understand and see where the roadblocks are and address them with the portfolio companies.
Got it, Anmol. I know you have a hard stop soon, so I'll just kind of conclude with one question that has just come in more from an operational perspective, that when it comes to making these kind of disclosures, can the fund do them directly, or does it have to go via a law firm or a consultant, and how exhaustive is this process?
Sorry, Divya, was the question addressed to me?
Yeah, I mean, either of you, if you could take it.
Sure. So we don't have a third party to actually collate this and report this on our behalf. We have developed a framework to ascertain most of these parameters, and we have an annual reporting mechanism in place already. So all our reports happen through the firm, and I think it would be essential to also maintain the quality of the data and to make sure that the verification happens from the portfolio company around the quality as well. So that's probably the reason that we have kept it in-house. But there is, I believe, no stringent requirement as to say who reports it, as long as the data from the compliant firm is reported.
Got it.
So there are my headphones, so I missed the question, but yeah.
No worries, Anmol. I think Vikram answered that. I know there are a host of questions and we have limited time for it, so I shall just leave you all with what we've just discussed. But thank you so much for joining in and sharing these perspectives. We hope to have a lot more conversations with you and just understanding and unraveling ESG and SFDR for everybody as we go. Thank you for coming today.
Thank you.
Thank you so much.
We have a few minutes where we could take in some of the audience questions that have come up, especially to BTG Legal and White & Case LLP as well. So we'll probably be just going through a few of the questions that have come up. Ranjana, in case you'd like to take any.
Sure, Divya. I believe there are a couple largely, understanding the regulations, if there have been any amendments to SFDR regulations which were expected sometime in April. Have these, amendments come already, or are we still waiting for them? Or are these, defining the sustainable investments in a better way? So Chris or Prashant, anyone can take this.
I can address some of that, I think. So as mentioned, there's a delay in a lot of the EU timetables on the level 2 rules in particular. So that the proposed amendments relate to the level 2 rules. Under the level 2 rules are often called the regulatory technical standards. So in this SFDR context, they specify the format of the pre-contractual disclosure and the periodic reporting, and some of the things, for example, in the latest iteration of that, it's really very sort of granular, almost formatting style changes that are proposed. So I think there is a delay in the amendments to those level 2 RTS, but I don't think if adopted as are, or I don't think they're going to have a fundamental change, because level 2 RTS cannot amend the level 1 SFDR. But as mentioned, it will be interesting to see in light of the final political negotiations, and it was, the big players, it was Germany, France, and Italy who pushed through the changes to the CS3D I mentioned. As the EU Green Deal is supposed to work, holistically in tandem, SFDR, CSRD, CS3D, they're all supposed to work together. So might we see some amendments to the SFDR now that the CSRD is the law, and in light of some of the kind of smaller dilutions around CS3D, in particular France pushing for amendments for the Green Deal as they relate to certain financial market participants, i.e. the big big French banks. So that would be my answer on that. And I haven't followed closely on the amendments around transition investments. So I don't know if anyone else on the call can speak to that, but there has been a slightly broader scope of assets that qualify, and that's, I think, is a direct result of the since the invasion of Ukraine.
Yeah, thanks, Chris, for that. And I think a quick, in succession, I would also ask that do the SFDR regulations also specify methodologies to measure the impact for investors?
Yeah, so if we're talking about, if environmental investment is objective, it's just very detailed under the taxonomy regulation.
Right.
The measurements that you've got to capture, and scope 1, scope 2, scope 3 emissions, and then you are being audited against that. So yes, I think there is some clarity around those things.
Sure, thank you so much. One question to you, Prashant. The RBI framework which you specified, is that based on the TCFD, which is the climate, task force on climate focused disclosures?
Yeah, I think it draws from all of these various consultations that were going on in leading up to the various COP meetings, and TCFD did contribute to the framework of the RBI disclosure norms. TCFD also contributed to PRSR, and going back to the point of measurements, Ranjana, from the previous question, we can take some guidance also from what RBI is looking at, or was looking at. SEBI was looking at under BRSR, reasonable assurance standards, measurements, metrics, and that I feel was a kind of revolutionary discussion. I think it has kind of cooled down a little bit. I hope it's not permanently cooled down, but the various measurements that are required, as Chris was talking about, taxonomy, various measurements that are required also require assurance from an audit sign off from the management and from some experts in certain cases under the BRSR framework. And I think going forward, we'll probably see similar measurement metrics being discussed for the RBI framework as well. Drawing again from various sources, including the SFDR and taxonomy there, the green taxonomy regulations there, but also drawing from the reasonable assurance standards framework that SEBI is talking about for BRSR.
Okay, and I think we have a couple of questions more, and I think we can quickly answer these two as well. One is, of course, that at what stage of investment should a GP conduct do no significant harm test and collect PAIs from the investee? And second is, of course, more in the context of the Indian companies, that what are the implication of SFDRs for, I think it's meant that the final investees, how should it change their lives?
Chris, Lavanya, do you want to take the first one?
Sure. So at what stage should a GP take this into account? If we're talking about, an Indian GP, if it's more than a remote possibility that you'll be doing some marketing to EU investors, those EU investors are most likely, or there's a good chance they'll be investing via an Article 8 fund, in which case they will definitely want that information. So, if you're confident there's going to be no marketing of the fund to EU investors, then, it's a discretionary point. But if not, you should be integrating, that the sustainability due diligence at the very start of your overall, investment due diligence process.
I'll quickly take the second question, Ranjana, which actually ties in with what Chris is saying. Actually, a lot is driven by the market demands, right? I mean, the investee companies will have to basically respond to what the market demands, what the investors demand. So if the EU investors who are Article 8 companies, the 9 companies are looking at diligence and they're asking questions on ESG diligence, then it's, whenever you're getting the investment, that changes your life. Even before you get the investment, we have, for example, an in-house ESG due diligence checklist now, which is optional and attached to the normal corporate checklist, corporate diligence checklist. And some of our investors ask for that ESG checklist to be added to the diligence procedure and the process right in the beginning. Other than the due diligence, I think the reporting framework has to change if there is reporting required on these ESG metrics. Metrics have to be identified and KRIs have to be identified. That's also under the RBI procedures and the policy and the framework. Board responsibility has to be fixed. And really, I mean, and to really price in some of these risks as well as compliance measures into your valuation or into your business plan or your operating margins. I think that's how it's going to fundamentally change. It's going to add a layer of cost, compliance, but also opportunity to whatever you do.
And if I could briefly add to that, I agree with what Prashant said. If you're an Indian company, by I understand you mean like an operating company, a real business, rather than a financial institution of some sort, then the short answer to that is you have no direct obligations under the SFDR. It only creates mandatory obligations on financial market participants and financial advisors. But as Prashant said, it's that market nexus that may make it indirectly applicable to you. If a lot of the end investment in your Indian operating businesses is coming from EU LPs, or maybe they're LPs elsewhere in the world who've just decided the EU is the global gold standard, so that's what we want, then as Prashant said, that's going to be transitioned to you, the operating burden of complying with that. But as I said, and I really do want to stress this, I said that SFDR it was kind of back to front, SFDR coming first, the market mechanism, and then the later part of the Green Deal, CSRD and CS3D, which applies to the operating companies. And many Indian operating companies, if they're doing 150 million of annual sales into the EU, they're directly in scope for the CSRD.
That's very, very helpful, Chris. And I think we got a very clear understanding of, what SFDR actually entails, both for the investors' perspective and finally the investees. They directly might not need to directly comply with the with whatever the SFDR entails, but indirectly, I mean, if the investors want, then of course the investees might also need to comply with all of those. So I think, yes, we have overshot the time by 10 minutes. So yeah, we would like to thank everybody at this juncture. Thank you so much to our knowledge partners for today, BTG Advaya and White & Case LLP. And because, without their insightful presentations and their views, this session would not have been possible at all. This have been very engaging, 1.5 hours, and I think all of us are going back a lot more knowledgeable about SFDRs, and I'm sure, I mean, many of you might still have some questions which remain unanswered. So please send them to us, and we can, redirect them to our knowledge partners and, get your answers to those questions as well. So big thank you to BTG Advaya, Low Capital, White & Case LLP, for sparing this time for us for this such relevant topic, and answering all of these questions for us. A big thank you to Neev Fund for helping us pick such relevant topics for the industry as a whole, helping us support this entire initiative. Big thank you to the IIC team, the machinery behind all of this to put this all together. Sonali, Varun, doing the heavy lifting in terms of, background reading, deciding agenda, Divya putting this all together so well by moderating it and asking all the right questions, and no doubt, Girish, who has led us, and provided with his guidance to, take through in all these initiatives. So we'll be back with next sessions in the series with more and more topics which are relevant for the industry, and we will we'll be in touch. So thank you very much. On this note, so we will close this webinar. The recording of this session will be available from, I think, tomorrow onwards, or maybe we'll take another day to put this together, and you many of you can review the recording as well. Thank you so much.
Thank you. Thank you, everyone.
Thank you, everyone.